who is an associate professor in the Department of Economics and Finance at the Lang School of Business at the University of Guelph. Hong's research focuses on insurance data analysis and risk management with applications to longevity, financial, and climate risks. Hong has published over 20 papers in leading insurance, actuarial, finance, and economics journals, and is a fellow of the Society of Actuaries and an associate of the Canadian Institute of Actuaries. And today he'll speak to us about spatial-temporal modeling of wildfire losses with applications in insurance-linked securities pricing.
Okay, thank you, David, and thank you everyone for being here. So today I'm gonna talk about modeling wildfire loss and some applications on cat bonds basically. So this title, Spatial-Temporal Modeling of Wildfire Losses, is actually the original title of the paper because back then we were so focused on modeling. So I will tell you where the spatial-temporal part is later on. So we were so focused on modeling frequency of wildfire. But later on, we have done so much more, so we kind of changed the title at some point. Anyway, so this paper is a joint work with Zhenxi Su from Purdue University, and is a project supported by the Casualty Actuarial Society. And this paper, I would say, this paper is the first part of a bigger project that we are working on. So I will talk about this a bit more at the end of the presentation. In the future research section. Okay, now let's get started. So, sorry, we know that wildfire risk is a rapidly emerging risk for human society. So we have been seeing so many news about wildfire in North America, in Australia, and in other parts of the world. And so here I just give some very simple, numbers. So in 2018 alone, wildfires in California has resulted in about $150 billion, including direct loss and indirect losses. Well, this is approximately 1.5% of the state's annual GDP. So I would say this is kind of a very substantial number, actually. And another thing, if you look at wildfire from a dynamic perspective, then you can see that actually, the wildfire activity has been increasing over time, so it's not static. Okay, so if there's no control that is put on wildfire, then we are going to see larger and larger costs over time. So here is a number from the National Interagency Fire Center, which is also in the States. So according to their records, there was a 17% increase of wildfire activity from 2019 to 2021, and a 223% increase since 1983. So here I just collect data from, well, I guess the fonts are a bit small. I hope you can see it, but I'll explain. So I just took data from this agency's website and create two plots. So the left plot is the number of wildfires over time from 1983 to 2021, and the right plot is the number of acres burned, the total number of acres burned in the whole country, in a year, okay, over time. So, well, first of all, we can see that both the number of wildfires and the number of acres burned are quite volatile over time, okay? And the number of wildfires don't exhibit a very clear trend, okay? So it's quite volatile, sometimes high, sometimes low. But for the number of acres burned, we can see that there's clearly an upward trend there. Well, probably that's related to increasing human activities in many of the regions, right? So I guess we probably don't have that much wildfire if we don't have human living there, right? In a certain region. So yeah, so there's the increasing trend of the number of acres burned over time. So the growing intensity of wildfire and the damages brought by this, the wildfires have stressed the balance sheets of insurance and reinsurance companies, right? So after a big wildfire event, probably some of the insurance or reinsurance company would decide to withdraw from a market, would decide to stop insuring some of the regions or some of the properties, right? So that would reduce the total insurance capacity in the markets. And as a result, the insurance premium will be higher, okay? So insurance will be less and less and less affordable, if nothing is done. So here is another example. So the California Wildfire Fund goes without. So this California Wildfire Fund is a fund created by some utility companies in the States. Okay, so this fund, the purpose of this fund is to cover expenses, caused by wildfire. So this fund goes without reinsurance or any form of risk transfer for 3 consecutive years up to 2022, due to market rates of the market rates of wildfire risk transfer solutions are so high. Okay, so they decided that so such high rates are not in line with their sustainable goal in the long term. Okay, so premiums are too high. So anyway, so based on the current market situation, we think that alternative risk mitigation strategies may be useful, to improve the situation of the wildfire risk transfer market. Right? So I mean, there are so many alternatives to traditional reinsurance, and we think catastrophe bonds is a promising option. Okay, it's because catastrophe bonds, with cat bonds, the hedge suppliers are no longer restricted to the reinsurance sector, right? So general capital market investors could also play a part in cat bond markets. So this provides a larger potential market capacity to the wildfire risk. And cat bond could be attractive. I think this is a well-known fact that cat bond could be attractive because the returns provided by cat bonds are almost, not entirely, but almost unaffected by economic cycles and financial markets. So it could provide a nice diversification benefits to investors, right? To endowments, to mutual funds, etc., etc. So yeah, so we believe that cat bond could be a promising alternative. And in fact, the global volume of cat bond has been growing quite fast. So the total volume outstanding of cat bond was $785 million in 1997, and it has increased to over about 38 billion in 2022. So here I just have a figure of the trend of the outstanding volume, which is the black lines here over time of the cat bond over time, and the blue line is the volume issue in that year of cat bond. So both the volume issue and the volumes outstanding are just growing over time. Okay, so anyway, we believe that cat bond could be an alternative to traditional insurance, or at least a complement to traditional insurance. Okay, cat bond. But speaking of cat bond, most of the existing cat bonds are multi-peril. Multi-peril means that the return of a cat bond is dependent on not only one, but multiple perils, right? So the return of a cat bond could depend on wildfire and flood, etc., etc. There are so many, perils and hazards that could be included in the return of a cat bond. So that would create, so a multi-peril cat bond is good because, different hazards and catastrophes kind of cancel out. So at the end of the day, if you pool a large enough, number of perils together, you may get a more stable and predictable return. So this is good for the investors, but this is not so good for the hedgers, right? So if you want to hedge wildfire risk at the end of the year, so say there's a huge wildfire, but there were no other perils at all. So the return of the cat bond will not be that good. It will not be related to your real loss. Okay, so this is what we call basis risk. Basis risk is the risk that what you get from the hedging instrument does not, really match what you have lost. Basis risk. Okay, so most of the existing cat bonds are multi-peril, so basis risk, and there are, just only a few wildfire-specific cat bonds in the market. Okay, so the first 3 cat bonds, so to the best of our knowledge, hopefully we haven't missed anything, but so the first few wildfire-specific cat bonds were issued in 2020, and as you can see, the volumes were not very high, right? 50 million, 90 million, 50 million, not very high. But fortunately, we saw a new series of all these 3 cat bonds issued again in 2021. So basically, all the 3 issuers have decided to renew their wildfire-specific cat bonds, in 2021. So hopefully, there is the trend, sustainable trend of, single peril cat bond, right, in the market. So in this paper, we are going to focus on the, we are going to evaluate the hedging effectiveness of single peril, wildfire-specific, cat bond on a typical insurance portfolio, insurance liability. Okay. All right, yeah. So this paper, so our work actually has two parts. So the second part is what I just mentioned. We want to evaluate the hedge effectiveness of wildfire-specific cat bonds. But before we do that, we need to have a credible statistics model to model and forecast wildfire loss, right? Otherwise, we're talking about nothing. So the first part of the paper is about a statistical model. I'm not going to talk about much of basically any of the technical details, but it is a two-part Bayesian state-space model. I will just show you the formula, some very basic formula later on. So we are going to use this model to forecast wildfire loss, and following the modeling of most of the insurance risk, we are going to model the frequency of the risk and the severity of the risk separately. Basically, we are going to have two state-space models, one for each part. Okay. And the challenge is to model the frequency, by the way. So that's where the spatial-temporal thing, kicks in. Okay, so this is the research agenda of this paper. And before I show you the model, let me show you the data that we use. Okay, so this is a fantastic data set. Spatial hazard events and losses database. So it's SHELDAS for short. So this is the data set provided by Arizona State University. You need to pay a subscription fee of like $700 a year, but it includes so many different kinds of hazards and perils. And it has a very nice panel data. So you can have data for every, actually, if you pay a lot more, you can have access to data for every single peril. So you can check, the exact date of, occurrence of a single hazard, peril, the area that it affected, and the estimated loss. So if you pay a lot of money, but if you only pay $700, then you can have access to some aggregate data. So you can see the number of each perils in each county, okay, at the monthly frequency for about 60 years. So the data set runs from 1960 to actually now it is updated to 2020, I believe. Okay, so but in this paper we use the data up to 2019. Okay, so SHELDAS data set. We are going to only focus on the wildfire data from this data set. We are going to use monthly data. So it has data from 1960 to 2019. And this one nice thing about this data set is that it includes two parts, frequency and severity. So it does not only include the number of wildfire occurrences across different locations over time, it also includes the estimated loss, both crop loss and property damages. Okay, so I think this is particularly important for insurance practices, because if you look at lots of other database, they only show you the occurrence of a particular catastrophe, but you don't know about the loss, right? There's no data or very few data for the loss. So it's very hard to model, for actuarial modeling, it's very hard to deal with those kind of data. So this data set, I think, is very handy at least. Okay, share the data set. And this is the frequency and severity from the SHELDAS data set. So the left panel here shows the number of wildfires every year from 1960 to 20. Also, right, the last year is 2020. So shows the data from 1960 to 2020 over time, right? So this figure to some extent is quite similar to what we have seen from the data from another institute, right? So here, so from this National Interagency Fire Center, we see a number of fires over time like this, the left panel. And from the SHELDAS data set, we see the frequency over time like this. Okay, so I would say it's not exactly the same, but close enough. Okay, so this is the frequency. And on the right panel here, here is the logarithm of the annual loss, okay, over year. Okay, so just to give you a sense of what the data frequency and loss look like, okay, over time. Still quite, especially the frequency is pretty volatile. I would say that the aggregate amount of loss after taking the logarithm looks okay, but the frequency is very, very volatile. So actually most of our modeling efforts was devoted to modeling and forecasting the frequency of wildfire. Okay, so this is the national data. And now let me show you the data for two specific states. Okay, the first state is California. California is by far the most heavily affected state by wildfire in the United States, right? So both the frequency and the severity in California is by far the highest among all states. Okay. So again, we see that the frequency is pretty volatile, but on average there are so many fires, every year, and the loss severity is also high here. Okay, California. I mean, from a modeling perspective, higher frequency is good for us because we don't want to have a lot of zero and all of a sudden a very large number and then a lot of zero afterwards, right? So this is unfortunate for people living in California, but actually it's better only in terms of modeling purpose. Okay, California. And second state is Colorado, which is the state very close to California. So we see very different patterns. So, well, first of all, over the first few decades, there were no wildfires recorded. Well, I think an important reason for this is that, in the early days, there weren't so much human activity, all over the states, right? So even if there was a wildfire, it probably was not recorded, and there was probably not a loss estimated for that particular file. So anyway, so during the first few decades, there were not that much observation. So by the way, so we are going to exclude the first few decades in our modeling. So I will talk more about this later on. But now starting from about around 2000, we have seen much more wildfire, and there are losses associated with the wildfires as well. And yeah, so Colorado is a very difficult state to model because as you can see, data are so scarce and so volatile, right? Okay, yeah, just to give you an idea. So I would say most of the states look like Colorado. So most of the states lie between California and Colorado, but it's closer to Colorado, okay. Right. Okay, so that was about the data. So now let me show you our statistical models. So yeah, we use a two-part models to handle the frequency and the severity separately. And as I said, most of our efforts were devoted to modeling the frequency. So now let me just talk a bit about the frequency modeling. Well, so the challenges underlying, modeling wildfire frequency, there are several, challenges. So the first thing is that, yeah, we see a lot of zeros, right? We see a lot of zeros in the data, okay, a lot of zeros. So we need to deal with those zeros. And the second thing is that clam count, so frequency, they are positive integers, right? So which means that if you want to use a model, whatever kind of model, you cannot use a continuous model because that will give you some fractional estimates of number of wildfires, which don't make sense, right? So whatever model you want to use, you need to use a count model, okay? Which means that, the model complexity is a bit higher. And the third thing is that I didn't really show you that many figures here, but there is actually a very, strong varying patterns, both in terms of time and in terms of states. Or actually, you can already see a bit of the difference here, right? So the spatial patterns of wildfire is so different, right? So across states. So yeah, time patterns and spatial patterns are dynamic and in some sense hard to model. So I think we think these are the few major challenges in modeling frequency. And well, yeah, some conventional models just don't want. I put most here, but yeah, actually, I guess this is a bit of an overstatement. But yeah, many of the conventional models are not really applicable here. Okay, so what we do here regarding frequency modeling is we use a so-called Bayesian dynamic count mixture model. It's a very fancy name. I'm gonna decompose each word one by one. Okay, so first of all, this is a Bayesian model, and this model it has two parts. Okay, so for the frequency modeling, we also have at least two regressions. We have two parts. The first part accounts for the large number of zeros. So we have a binary term, first of all, to determine whether there is or is not wildfire in a month in a particular region. Okay, so the first part is a binary part, determining whether there is wildfire or not. The second part is a conditional shifted Poisson. So actually, the second part is a counting process. Okay, so if there is wildfire, we want to model the number, right? So we want to count, and because there is already wildfire, so we don't want to have zero. We don't want to include zero in the counting model. So we have a shifted Poisson, which means that we exclude zero from Poisson. Anyway, well, yeah, so we have a two-part binary and shifted Poisson model here for the, so this is mixture. Okay, mixture means we mix binary and counting. And this is a count model because it is focused on positive integers. So it's a count model. Okay, so this combination allows for large probabilities of zero over time. It also allows for dynamic patterns in both the binary parts and the Poisson part. So this is what temporal comes from. Okay, remember the original title, spatial-temporal. So this is what temporal means. Okay, dynamic, and also this model has a very computationally efficient features so that we are allowed to model the wildfire frequency of multiple locations at one time. So we call this, well, this is called a multi-scale model, which means that we model multiple geographical locations simultaneously. So this model accounts for spatial dependence between different locations. Okay. Oh, I mean, in fact, most of the model can account for this so-called spatial dependence if you have a super powerful computer and if you want to wait sufficiently long time, right? The challenge is really how to do it in a computationally efficient way, right? And actually, this model is actually super efficient. So one run of the model takes, so we include the majority of the US states in our analysis, and one run takes maybe 5 to 10 minutes. So it's actually super efficient. Okay. Anyway, so here is just a very brief research review. It's not really a review, just to show you. There are these many kinds of Bayesian dynamic models in the literature. The first kind of model is the most standard one. It's called dynamic linear model or generalized linear model, which is super standard. The second one is dynamic binary model. The third one, which is the model that we build on, is dynamic count mixture model. Okay, so it's just one step forward. It combines binary and a count process. Okay, and this is what the model looks like from a nutshell. So first of all, let's denote the frequency. Okay, let's call NIT the number of wildfire occurring state I at time t in month t. We are going to use monthly data, and I goes from 1 to n, t goes from 1 to t. So we have a panel data. Okay, and if you like, you can model county level data as well. So you have a much bigger n and the same value of t, right? Depends on what you want. And we create a binary dummy variable ZIT. So this ZIT takes two values, 0 or 1. So it takes value 0 when there was no wildfire in state I at time t, and it takes 1 otherwise, right? So this is ZIT is really an indicator of whether there's wildfire or not. So this is the binary components, and yeah, and the distribution of and of course NIT is the counting component, right? NIT is the number of wildfire. Okay, so the distribution of ZIT is given by a Bernoulli distribution. Okay, and the intensity, the probability inside this Bernoulli distribution is also time varying. Okay, that we have to estimate, and the distribution of NIT has two parts, right? So when ZIT is 0, which means that there's no wildfire, then of course N is 0. And on the other hand, when there is wildfire, NIT follows a shifted Poisson, right? So XIT here is a Poisson, and we add this Poisson by 1 shifted Poisson. So we get rid of 0 basically. Okay, so XIT follows a Poisson distribution with a time and spatial varying intensity as well. Okay, so everything is time varying, everything is geographic location wise also varying. So it's really a dynamic model in many different sense. Okay, yeah, so these are the state space regression. I mean, you don't even need to know what they mean, I guess. So basically we just, so in this part, we want to estimate the probability in the Bernoulli distribution. Pi IT is the probability in the Bernoulli. So we do some transform. I mean, if you are familiar with GLM, then this should look pretty standard. So we take a logic transformation of the distribute out to the probability, and we fit this logic transformation by a linear model. And the only thing is that here we have a state space model, meaning that a part of this regression is a latent variable. Okay, so in a normal regression, we use only observable variable, right? So if we want to fit, for example, the weight of a group of people, we may use age, height, gender, blah, 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 but all those variables are observable. Okay, so we can actually measure and collect the numbers. But in a state space model, a part of the regressors are just latent. You don't know what they are, so they are actually learned from the data themselves by the model state space. So here we have some dynamics for the latent variables, etc., etc. Okay, so this is just a typically state space model. And as you can see, all of the vectors and matrix of coefficients, you know, everything here has two subscripts at least, I and T. I means geographic variation, T means time variation. So everything is varying across time and location, okay? So this kind of model would be, well, very hard, if possible at all, to be estimated in, you know, using a frequentist, you know, method. But in a Bayesian framework, you know, everything depends on, you know, distributions, right? So as long as you impose a nice, beautiful prior distributions for the parameters, you would end up with a nice and beautiful posterior distribution. So basically, you can estimate all these factors, you know, even if they vary across time and location. Okay, yeah. So this is the, you know, the model for the binary parts, the occurrence of wildfire or not. Okay. And the second part, so we also have a state space model, but this state space model is for the shifted, well, it's for the Poisson, okay? It's for the original Poisson distribution. To be more specific, it's for the intensity of the Poisson distribution. So again, this is kind of like a GLM, right? So we take the logarithm of the Poisson intensity, and we fit the logarithm of the intensity by another linear model. And again, because this is a state space model, we want to allow for more flexibility. So we include a latent state variable here, and so we have to add an extra formula equation to model the dynamics of the latent variable. So because we cannot observe the variable, so we have to model its distributions over time, right? Stuff like that. Okay, so this is the Poisson state space model. Okay. And final feature, so I believe this is the last technical slide. Yeah. So final feature, I mentioned the multiple scale thing, right? So we want to take into account the spatial dependence across multiple locations. So we have, so right, remember everything here, everything in our state space equation has two subscripts at least, I and T, right? Which means that everything is varying across location. And on top of this, so of course, this is a good feature, but on top of this good feature, we want to introduce something more stable and more common into the model, okay? So we want to take into account the spatial dependence across different locations. So at the end of the day, we do want some factors that are constant across location, right, in the model. We only want something that varies over time, not location. So we have this phi t. Anyway, so this phi t is the common factor in the model. And yeah, it makes the model multi-scale. That's it. Okay, and yeah, so these common factors, phi t represents the common drivers. You know, you can have so many different interpretations attached to these phi t factors. You know, it could be anything not explained by the state-specific covariates. Okay, it's just something common. And phi t could be observable variables. So for example, if you want, you can use the national level average temperature. I'm just giving a random example, okay? You can use whatever. You can use the national GDP if you want as a common factor. The only consequence is just that your model fitness will be poor, but you can use whatever observable factor as phi t, or in a more data sufficient way, you can use latent variables as common factors. So this is the beauty of, well, this kind of model. that you can first fit model A, a benchmark model, to something else, and you extract some factor from that model A, and then you fit this, dynamic cow mixture model as model B, and in model B you add this phi t, which you have extracted from model A, as the common factor. Anyway, so here we can do it in multiple sequential steps, and the beauty of doing it in multiple steps is that, okay, so if you do this, then the model would become very, very efficient to estimate. So think about this. So if you say you have a lot of states and a lot, you have a very big panel data sets, you want to fit the multi-scale model, and you want to estimate everything together at one time. You want to estimate phi t together with all these, states and time-dependent variables at one time. The model would be impossible to estimate. Okay. I don't think there are, updating algorithm for this kind of estimation because they are simply prohibitively difficult. Okay, so we do it in 2 steps. We first fix phi t in whatever way you want. You pick national GDP as phi t. The thing is that phi t is known, right? Or you estimate phi t from something else. The key point is that phi t is known at the time you estimate, your state-specific model. So this would reduce, first of all, this would reduce the computation intensity, and second of all, in this, well, actually these 2 are the same point. So when the model estimation is so efficient, you are free to add as many locations as you want, right? Say you want to model the county-specific wildfire, in the states there. I don't know how many, a few thousand counties in the states. So if you do this, then the computation intensity increases linearly over I. So if you want to add 1 extra state, you only add, anyway, it increases linearly over time. So it allows you to add as many locations as you want into the estimation, okay, which is nice. I'm gonna say a bit more about how we estimate this phi t later on in the empirical section. Okay, yeah, but this is basically the frequency model, okay, the frequency model. And the second part of the loss modeling is the severity model. Severity model is super simple. We use dynamic linear model, very, very simple, just 1 line of code, okay? I mean, I'm not saying that severity are so easy to model. It's just that we just can't do too many things at a time in a paper, so we use a very standard model for severity. And actually, the modeling of severity is the second part of the project. So I will say a little bit more about this later. Anyway, severity modeling, simple dynamic linear model. Okay, now let's go through the data analysis and then the bond pricing hedging analysis. Okay, we first need to fit the data. So again, shelters data, but also monthly state level data, but we start from 1989. We don't want to include 1960 or those early decades where there was basically no data, right? No wildfire. Okay, and for practical reason and also for computational reason, we exclude states with fewer than 15 wildfires over the whole sample because we don't want to have a state with only 1 wildfire over the 30 years. Doesn't make sense. First of all, nobody cares about wildfire risk in that state probably. Second of all, if you have so many zeros in your data, that will only contaminate your estimation. Doesn't make sense, doesn't worth it, okay? So we focus on states with over 15 wildfires over the whole sample, and we end up with 32 states. These are the 32 states, so if you're interested, you can take a quick look. So I would say most of the states are from the western parts of the country, right? And there are, of course, there are also some from the east side. Anyway, so these are the states that we include in our regression analysis. Now, how we do the regression? So first of all, for the frequency part, we fit the multiple scale DCMM model. And what we do here, so remember, so I mentioned we want to first extract a common factor from model A, and then we fit our model B, right? So our model A here is a Poisson dynamic generalized linear model, okay? So we just fit a GLM, basically a Bayesian GLM model to the whole national data, okay? And from the national data, we extract the latent factors representing the time effects, basically. So, okay, so we want to use the national time pattern seasonal pattern of wildfire occurrence as the common factor to guide our estimation of state-specific wildfire frequency. We believe this makes sense because if you only look at some states, for example, Colorado, it's very, very hard to extract anything meaningful from this kind of data, right? Very, very hard. So we want to have first impose a national seasonal effect, which hopefully are much, much more stable and relevant. And then we model the state level frequency as sort of deviation, right, from the national frequency. So this is what we do. This is what we do. And and then we use these extracted effects as common factors, right, in the model. So this is what we do for the frequency modeling. And for the severity modeling, single scale dynamic linear model, very simple, one line of code. And finally, this is something that's a very, strong assumption. Well, it's probably not an assumption that we made. So the thing is that we didn't include any exogenous variable this time. What I mean here is that we only, so it's kind of like an extrapolation model. We extrapolate the historical pattern of wildfire to predict the future of wildfire occurrence or wildfire loss. Okay, so we actually try, we have tried to add some of the explanatory variable, for example, temperature, precipitation, this kind of thing. But unfortunately, it didn't turn out very well. So in some case, the goodness of it is even worse when those exogenous variables are included. And we have a lot of explanation for that. So for example, the occurrence of wildfire is more closely related to human activity, for example. So let's say you set a bonfire in a forest. It might cause a forest fire either on a hot summer day or a cold winter day, right? Stuff like that. So when you have more and more people living in the same state, more and more economic activity, then probably, at least during the very short term, because for property, casualty insurance, our intrinsic forecasting horizon may be just 1 to 3, 5 years maximum, right? So over this short period of time, I'm not sure whether climate, the trend in temperature, et cetera, would have a very strong impact on, at least on wildfire. At least we didn't find anything, okay? So we decided to exclude these exogenous variables, and excluding exogenous variable also has an advantage. Suppose you have a lot of exogenous variables in your regression and you want to forecast into the future. The first thing you need to do is not to forecast wildfire. The first thing you need to do is to forecast your predictor. You need to predict your predictor before you can really do the prediction, right? You need to know what the temperature would be in the next 5 years before you can use them to predict wildfire. So that is not, well, people do that all the time, but yeah, theoretically speaking, that imposes another layer of noise, right? Or model misspecification risk. Anyway, so this is some justification that we came up with. But the thing is that using only wildfire data to forecast wildfire actually gives us a very reasonable results. Okay, so we will take a look now. So what I show you here is a very simple out-of-sample forecast analysis. So we do our initial estimation using the first 15 years of data, and then we are going to do a rolling window, okay? So at each point of time, we are going to forecast 1, 2, 3, 4, up to 12 months ahead. We want to do an out-of-sample forecast of 1 month to 1 year, and we just look at what we do, right? So at each point of time, we update our data and we do this analysis over again. We want to know what we do. So first of all, let me show you the regional results, okay? So remember, we have a table of states, right? So we can divide the states into a western part of the country and the eastern part of the country. So this is the one-step out-of-sample forecast, okay? So for each point and the left figure is the western states overall, and the right figure is the eastern states altogether, right? So for each point here, so each point here, each line here means a out-of-sample forecast result, okay? So I don't know whether you can see it clearly here. So we do have a solid blue line here, down here. So this is the posterior mean of our of our out-of-sample forecast distribution. And we also have the 99% confidence, credible interval, okay? And yes, 1 month ahead forecasting, Western and Eastern. So I would say not too bad, right? Not too bad. It's reasonable. And 12 month ahead forecasts, okay, slightly worse, of course, because we are forecasting further into the future. But I would say still reasonable. By reasonable, I mean that first of all, the posterior mean is able to capture the pattern. Second of all, the confidence interval is able to cover most of the realization. So you can see that the wildfire, frequency is actually very volatile, right? But we are still able to capture, although sometimes the confidence interval is a bit wide, but we are able to cover most of the observations, right? Not all of them, of course, but after all, this is just a 99% interval, right? So we have 1%, we are allowed to have 1% of outliers, outside the intervals. Anyway, okay, and finally, this is the 5-year forecast. So this is not the out-of-sample forecast anymore. We use all the data we have to do the estimation, and we forecast 5 years into the future, okay? So this is the 5-year forecast for the Western region and the Eastern region. And something funny is that, well, not funny, but something interesting is that you can see here that the posterior mean for the Western region is increasing over time, means that our model predicts there is an increasing number of wildfires in the Western states altogether. On the other hand, the posterior mean of the Eastern states is decreasing over time. Okay, so we need to be very cautious about this kind of model. I don't think we can extrapolate this model indefinitely into the future. We cannot use this model to forecast wildfire activity 50 years ahead. Doesn't make sense, okay? Because, well, if you use this model, then in 50 years, probably there will be no wildfire whatsoever in the Eastern state because you have this downward slope, right? But over the short term, I think this kind of extrapolation, well, is acceptable. That's what we believe, okay? Anyway, so let me quickly show you the results for California, similar, right? So left panel 1 step, right panel 12 step, okay? So still our intervals are able to cover most of the realizations, right? And the forecast, right? Looks very similar. Okay, you might think, producing this kind of interval is not a big deal, right? So you can come up with whatever model and you can have this kind of interval that can cover most of the realizations. So here I just show you what would happen if you use a very simple zero inflated negative binomial model regression. Okay, so without many of the stuff that we did, you would probably end up with something like this. Okay, still you would have a reasonable seasonal pattern estimated from the model. But the thing is that your interval would not be able to cover many of the real wildfire frequencies. So which means that if you use this model to do risk management to set your capital reserve, then you might run into some kind of trouble, right? Well, I'm not saying that the zero inflated negative binomial is the benchmark or very good model, but yeah, it's just a very common model that people might use, right? Okay, yeah, so here I show you the severity forecasting. Okay, it's not. Okay, so similarly, we are able to cover most of the realizations, but severities are not very volatile. And of course, the zero severity are not covered because we don't care about the years without wildfire. So let me quickly go through the cat bond pricing and hedging analysis. So what we are going to do is we are going to create a hypothetical cat bond here. So first of all, we calculate the aggregate loss over K month, the future K month, right? So we first predict the number of fires and we predict the average amount of each fire. We multiply them together, we get the total loss, right? So we have LIK. This is the aggregate loss of in state I over K month. And this is a random variable for sure, it's future loss, okay? And we create a cat bond that looks like this. So the idea is that as an investor, you pay the face amount, you pay PIK, which is the face value to get this bond. And at maturity, you get return, right? And the return has 2 scenarios. So first of all, if the loss is below a trigger point, you get full return. Full return meaning that you get all of your face value back plus some interest, okay? Full return. And on the other hand, if your loss is above this trigger point, you get a reduced face value plus your full interest return. So in any case, you get your interest return in full, but your principal may be reduced by a percentage, okay? So this percentage F of LIK is called the loss ratio. You get so if the loss ratio is 1, you get no face value back, something like that. Okay, it's a very, very standard cat bond, I believe. And the interest return looks like this. So the interest return includes the risk-free interest return plus a spread premium rate, L tilde IK, okay? And we actually did some work to price this, L tilde IK, of course, using the results of some existing literature. And yeah, I will show you one number later. And this loss ratio looks like this, okay? So if L is below the trigger point, the loss ratio is 0. If L is bigger than the trigger point, then the loss ratio increases linearly over loss, right? And finally, if loss is above an exhaustion point, loss ratio becomes 1, you get nothing back, right? So this is really like a linear reduction in your principal, in your face value, okay? So, all right, so in the paper, we have done more pricing analysis, but this is just a very, very, very simple pricing formula. So I'm going to show results based on this linear pricing formula here. First of all, we are going to use K is equal to 12 in our analysis. So we look at a 1-year loss, okay? K is month, right? 12 months. So yeah, so the premium rate is equal to this formula, okay? We first calculate the expectation of, we first set a trigger point and an exhaustion point, and then we calculate the expectation of the loss ratio, and we calculate the spread premium rate. And these rates range from 3.8 to 3.20 in our analysis, which, so this is the percentage of the face value, okay? This is basically the price of the bond. We did some analysis, okay? So we consider 3 representative insurers in California, Colorado, and Oregon, okay? Those 3 Western states. And we assume that there is only one insurance company in that state which is responsible for all the losses in that state, okay? So we just use the state level data to represent the liability of those insurers. We consider a 1-year horizon. We want to look at the hedge efficiency of different setup of cat bonds. We are going to use the same structure, but we are going to pick different numbers, right? So we are going to look at 4 scenarios. So in the first 2 scenarios, we assume that the face value of the cat bond is 95%. It's the 95th percentile of the forecasted 1-year loss. Okay, just a number, right? You can pick different numbers. And the trigger point is the 90th percentile. The exhaustion point is the 99th percentile, right? So just some. So this is which means that when loss is below the 90th percentile of the predictive distribution, then you return the full face value to the investor, right? So this bond, the first bond, only hedges the 90 to 99 percentile of the loss, something like that. Yeah. So for bond 2, trigger point 95%. For bond 3 and 4, we increase the face value to 99% of the forecasted loss, and trigger point 90, exhaustion point 99, and trigger point 95, exhaustion point 99. So in scenario 2 and 4, we are looking at the further right tail, right? We only look at the 95 percentile to 99 percentile. We look at different situation, different risk preference of insurance companies, right? So this figure shows the histogram of the forecasted 1-year loss. So L is so this is the histogram of L. So you can see that the tail is super thick. I mean, the mean is basically 20 billion or so, but the tail can be 1,750 billion, which I don't know whether this, but this is something created by our model, okay? And even if we truncate our distribution at the 95% quantile, so I'm not truncating in the hedging analysis, I'm just truncating to show you how fat the tail is, okay? So even if we truncate it at the 95th percentile, still pretty skewed, okay? So this is what our model produced. I'm not saying this is the correct distribution, but yeah, this is what we learned from the data, okay? So now let me first show you the unhedged loss. So this is the original loss, the summary statistics of the original loss of the 3 states. So first of all, the mean, right? So you can see that California is by far the largest state that is exposed to wildfire risk. The forecast mean loss is $12.89 billion. And Colorado, Oregon, they are much smaller, okay? And what's more important is that you can see that the standard deviation much bigger than the mean. The percentile about 30 times bigger. So if you look at the 99.5 percentile, about 30 times bigger than the mean. Super big, super skewed. Okay, so this is the unhedged loss. And now, this table shows the hedged loss for California. Okay, so we use 4 different we look at 4 different scenarios, right? So in each of the scenarios, we use a different cat bond, and we can end up with a different distribution of the hedged loss. And here I just show you the percentage change of the hedged loss versus the unhedged loss. Okay, so for example, if you look at scenario 1, so if you hedge with the scenario 1 cat bond, then your mean loss would increase by 1%, and the standard deviation of your hedge loss will be reduced by 4%, right? Just the table is quite easy to read, and yeah, and your tail loss would be reduced by maybe 12 or even 54%, depending on what kind of bond you use, right? So if you use a very conservative bond, if you're super risk averse, you hedge with a very conservative cat bond, you need to pay a price. So your mean loss will be increased by 18%, but your tail loss is going to be reduced by a lot. All depends on what you need, what you want, right? So this is for California, a state with a lot of wildfire and very reliable data. And now this is for Colorado, a state with much less wildfire data, right? So in practice, this might be a much smaller insurance company, right? Something like that, with much smaller portfolio size. But anyway, we see very similar results. So depending on your risk preference, you can hedge with an aggressive cat bond, only bear a small cost, but then the hedge effectiveness will be a bit lower, or you can pay a lot and greatly reduce your tail risk. And this is the result for Oregon, pretty much the same. Oh, this is not 0, this is just 0 point something, okay? Just relative, you still need to pay something, but not that much, okay? Yeah, the pattern is all the same, right? The more you pay, the more risk you get rid of. So yeah, so now conclusion. So actually we have done so many things in the paper that I have no time to show you, but anyway, so that is the key results that we have. We have a 2-part Bayesian model to model wildfire loss, which I believe can be applied to modeling all kinds of different losses, not only wildfire. And we evaluate the hedge effectiveness of cat bonds. Okay, so now please allow me, to spend a few minutes talking, this future research direction. So as I mentioned in the very beginning, this paper is part 1 of a bigger research project. And the second part of this research project is item number 1 and 2. We use a very simple model for severity modeling. So we want to look into these aspects. We want to see if we can have a better model for severity modeling. And we want to look at multi-peril. We only look at wildfire. So maybe there are some other disasters with a pattern similar to wildfire. So if we couple them, or if we pool more perils all together, we may improve the forecasting accuracy for all of the perils. And we want to look at multi-peril cat bond pricing. I mean, I mentioned multi-peril cat bond pricing has basis risk, but after all, it is the dominating kind of cat bond so far in the market, so it's worth looking at, right? So we want to look at multiple perils at the same time. We want to model severity, joint modeling, hopefully. We want to look at the cat bond pricing. So this second part of the project is funded by the Canadian Institute of Actuaries and CAS together. Okay, so hopefully we will have the final contract ready and start working later this year. This project is with Senshi Su as well, but we are more than happy to have new collaborators on board if you are interested on this part. So this is more like an immediate future research. And item number 3, we want to look into the exogenous variable thing. We didn't have any exogenous variable which has both pros and cons. So I mean, I guess the biggest advantage of having exogenous variable is that you can evaluate the impacts of one variable on the loss, right? So for example, if you include temperature, then you can look at the impacts of the temperature being 2 degrees higher on everything, right? So you can really do this kind of scenario analysis, and you can also do stress tests, right? So if temperature is 4 degrees higher in 50 years, what would happen, right? So all this kind of analysis is not possible if we don't have temperature in the model. So we are going to look into these aspects. So maybe it's not that promising for wildfire, I don't know, but it might be more promising for different kinds of catastrophes. We have no idea, right? Yeah, and finally, we want to do more hedging analysis. We want to look at index-based bonds. We want to look at combinations of cat bonds and traditional reinsurance. We want to look at liability-driven investment, although I don't know empirically whether there's any investment option that share the same risk factor as catastrophe. I have no idea. Probably the most efficient way is to short the stock of your fellow reinsurance company. So when the disaster hits, their stock price go down, you earn money, right? No, just kidding. And maybe we can also look at the natural hedging kind of thing. So in life insurance, we know there is a natural hedging potential of life insurance portfolios and annuity portfolios, right? So if the life expectancy is higher, then on average, you pay more on annuities, but you pay, I mean, in terms of present value, right? You pay less for the life insurance portfolio. So for natural catastrophe, I don't know if there is such potential that we can look at. So for example, if a year has more floods, maybe it will have less wildfire. No idea. Or if a year has a higher, stronger wind, maybe there will be more wildfire. So maybe there are some correlations that we can explore to sort of like create a natural hedging portfolio so that the cost of hedging will be further reduced. Right? Something like, okay, so this is what I wanted to say today. Thank you very much for your attention. And yeah, this is my email. So Jianxi and I are more than happy to discuss